All right, Happy New Year. We are kicking off this year. We're on still a negative note here when it comes to risk assets here this morning. Let's bring in Shana, Sissel, president at Banríon Capital Management, who joins us with the latest on her outlook for this year. And Shana, you know, we talked about the superlatives, the worst year for global equities since 2008. Global bond markets are also been in turmoil as well. Are you optimistic about a better 2023?
I am, but I don't think it's going to happen in the first half of 2023. I think this is going to be a little bit of a similar playbook to what we saw in 2009, where the first few months of the year were quite rough before we really bottomed out. I think that's going to be the case here. Of course, the drivers of the headwinds for the market now versus then are quite different. But I think the job market is still very tight here in the U.S. and as long as the labor market stays as strong, the Fed is going to be emboldened to continue an aggressive policy of tightening. And that is going to be a headwind for equities. I also think that earnings are really going to struggle. And as we see Q4 start to be reported and also Q1 2023, we've had some negative guidance. The consumer in the U.S. is not as strong as it has been. And I think all of these things are going to contribute to having a pretty difficult first half of the year. But I do see things turning around in the second half. So I'm positioning accordingly.
Okay. And maybe part of that equation is also China reopening. How do you see this all being played out across the markets? Obviously, it's good for the services sector. Demand for commodities, people are saying, could be a big bounce in that front. But how do you play that?
So it could go a couple of different ways. Clearly, the Chinese consumer will fill the void the U.S. consumer is kind of leaving. So that could actually balance out global growth. My bigger concern is that the increase in demand we'll see, because just like we saw in the U.S. when we did our full reopening, I expect we'll see this in China, where there's a lot of pent-up demand for services. And so that will also affect commodity markets as we talk about, travel that increases the demand for jet fuel and so on and so forth. And so those things will really push those types of commodities upwards, which actually could be bad news if you're trying to get a handle on inflation, global inflation, and it kind of limits the impact that Fed policy can have on global inflation rates, especially with commodities, which are a major part of the CPI here in the U.S. So we could see some strength and demand, which obviously is good, but that could also be difficult for people who are trying to control inflation.
So I mean, everyone is looking at the second half and saying, look, brighter prospects, whether it's for markets, whether it's for China as well. Do you see past and look past the bad data that we're seeing here right now, the COVID infections in China, these travel restrictions that we're seeing across the world? Do you just look past that and just focus on maybe buying on the dips in these markets, or do you stay defensive?
I am starting to get slightly more aggressive in my stance. Now, I haven't moved away from my overall defensive positioning, but I'm taking the opportunity to be opportunistic in increasing my equity beta. So I am doing that using some liquid alternatives where I'm just increasing the exposure I have to equities while still having a hedge on. So there's an ETF that I'm using to do that, MRSK, that kind of allows me to add some opportunity to get some upside if equities go up, but still have a hedge on my portfolio because I'm not completely confident that it's going to happen in the first few months. But if I'm wrong, I'll have some exposure. I think that there will be some limitations. I think the Fed will continue to be aggressive in its hiking cycle, and they are sort of fixated on that 5% rate. A lot of people think they're going to cut in the second half of the year. I don't think they will. I think that that's completely too optimistic. They may pause, which is a good thing, but I don't think that they're going to end their hiking and then start cutting right away. I just don't foresee that happening. So I think that there will be some positive things that will happen in the second half of the year that make me want to be slightly more aggressive in my portfolio positioning. But more of the opportunities right now I'm seeing is in the fixed income markets more than the equity markets.
Shana, when it comes to the profit recession, do you think we're near the bottom? Do you think last year was the worst of it? And when do you start seeing an improvement?
I actually don't think we're past it. I actually expect earnings and profits to be very difficult, and as we get the Q4 results in the next few months, and then I actually think that will probably have some spillover into the Q1 results as well. But I really think it kind of ends there. I think companies are prepared for this. I'm not sure if and when we have a recession, it will be a deep recession, which I think most companies are positioning themselves, have strong balance sheets, and so they'll be able to kind of ride that wave a little bit better and then recover more quickly. So I think we're not at the bottom in terms of earnings and profits, but I think we are a quarter or two left of that until we see the turn. And the markets are always forward-looking, so I think the markets might start to turn in Q2 in particular. So that's what I'm keeping my eye on.
It was the worst year for tech since 2008, and even that Santa Claus rally didn't really have legs. But I note that Apple is one of your picks. There's significant uncertainty when it comes to the outlook, particularly when it comes to China there.
Absolutely. And Apple has been punished as a result. It's still trading at a slight premium. It's trading at about 20 times. So it's a slight premium to the market, but deservedly so. Apple's a strong company with a strong balance sheet. It has over $48 billion of cash. So I think Apple, like I said, will be able to ride through this. And as China reopens, there will be some hiccups, I'm sure, but then you'll see increased demand for services and goods, and some pent-up demand for probably some product as it relates to Apple. I know they have some new product opportunities. I keep hearing that they want to compete with Meta in terms of the augmented reality kind of products. I do think new products are going to be a positive for Apple, and I think in the second half of the year we'll see Apple's stock really react to that. Do I think it has tons of upside? No, but it's a very good, well-run company with strong balance sheet, strong product lineup, great brand loyalty. And, 120 is kind of the point where I start dipping my toe into adding a position in Apple. And we're right about there.
Shana, thanks so much for kicking off the new year with Shana Sissel, their president at Banríon.